editor of Africa Capital Digest. I'm delighted that you've been able to join us today for what is the second of 5 episodes of Meridian Africa, our webcast series that we developed in partnership with strategic advisory consultancy based in Washington, D.C., KRL International, which is designed to get some insight and expertise from key people making the investments in Africa, about their approach to private capital markets in Africa today. So, as everybody knows, a handful of sectors dominate investment interest in Africa's private markets. They're driven by both global and local factors. The race to extract rare earths and minerals is hotting up. The demand for digital infrastructure has never been hungrier, and the need for renewable energy has never been more pressing. And the transport and logistics requirements stemming from Africa's business to consumer sectors is always increasing. If you combine that with the growth and rapid urbanization of Africa's population and the vast numbers of SMEs starved of investment capital, investors seem to be faced with a broad range of lucrative opportunities. So what we hope to do today is find out how investors are making sure they maximize their financial impact returns. You know, which sectors are offering a genuine opportunity to capture and create additional value, and what specific characteristics of the African market either hinder or help investors optimize the outcomes of their investments. Some of the most active and successful market participants on these strategies are joining us today to discuss these new realities. And we're going to start to discover where the best opportunities exist and what's needed to take advantage of them. So what can you expect over the next hour or so? Enko Capital Saad Sheikh is going to share his insight on the private credit space. Biju Mohandas, who heads LeapFrog's healthcare and life sciences worldwide, is going to discuss private equity value creation in that sector. And Kobina Sam from 91 will give his perspective on the most pressing and capital-hungry sector on the continent, infrastructure. So before we begin, I've got a couple of housekeeping notes. All attendees are in listen-only mode. You can submit questions through the Q&A chat as we go along, and we'll try to get to as many of them as possible. The presentation materials discussed during the webcast are partly available in the resources section of this webcast, but we will also provide them to you after the event, along with the link to an on-demand replay. We hope to get that to you within the next 24 hours. So let's get the ball rolling. First up, ADCA published their State of the Market for African private capital markets just a couple of weeks ago. And I thought as a starting point, it would be useful to get some context for our discussion going forward. The headline, we've created a sort of headline piece, which is attached in the resources section of this for you to take away, and we will send it to you afterwards. But in summary, their conclusion is that after looking at the data from 2025, that the private capital market is one that's recalibrating and it's not retreating. Fundraising has become more selective and specialized, and investments are stabilizing, and exits are strengthening. And Africa was the only region globally to grow deal volume last year. So if you dive into those numbers a bit further, we'll find on the fundraising side that last year, a total of $2.7 billion was raised by the private capital markets. Private equity accounted for the larger share of that. In total, there were 16 Africa-focused funds across all asset classes, which reached final close in 2025. It's down a little, 34% in value, and 27% in fund count year over year. As I said, private equity was the large share of that. $1.4 billion was raised for private equity. And notable closes included Meridian Capital closing its fourth fund, and Amethyst closing their third fund. Infrastructure raised almost $1 billion, 995 million, just shy. Private debt, 7 funds at interim close represent about 2.0 billion expected to be converted over 2026 to 27. So there's a strong pipeline in the private debt space. And venture capital was hit the hardest. They only raised 107 million across 6 funds last year, and that's lowest share recorded on record. And specialization, and sector specialization is defining how LPs are putting their money to work. Healthcare, agribusiness, and energy are the recurring focus areas. If we look at deals, so last year there were 530 deals completed. There's a 8% growth year over year, and as we mentioned a moment ago, Africa is the only region globally to record a growth in deal volume. Of those, private debt surged with about 57% growth year over year, where there were 72 transactions. It was the strongest performance on record. And venture debt doubled. Infrastructure also surged by 47% year over year. There's 1.3 billion in value, driven by supersized deals. Actors led the SwiftNet acquisition of 370 million. That's one highlight. The PE deal volume is at a decade high, despite value falling 32% year over year to 1.3 billion. The sub $10 million deals are now two-thirds of private equity activity. And in terms of regions, South Africa, or Southern Africa, I should say, is the largest destination with 1.6 billion raised across 153 deals. It represents 36% of the total deal value. And East Africa is the fastest growing region. Investment value is up 75% year over year to 1.2 billion and is now Africa's second largest investment market. In terms of exits, there were 81 exits recorded. It's up 27% year over year, and it's the second highest annual total on record. Around the rest of the world, global exit declined by about 15%, which is a good divergence for Africa. In terms of buyers, trade buyers accounted for 38% of the exits. Secondaries accounted for 26% of the exits. And then local buyers dominate. They are responsible for 68% of acquisitions. And among the international buyers, 67% were trade acquirers. In terms of holding periods, the average holding period in Africa is at 6.7 years versus 6.5 years globally. So it's converging with the more mature market norms. So hopefully that will set some context. We are really focused today on two of the most rapidly growing markets, private debt and infrastructure, as well as an important private equity market, which is the healthcare sector. As I said, this summary is actually available in the resources section of the webcast, and we will also include it in the post-event communications, along with a link to the fuller report from AFCA. So let's next up, let's move on to our first speaker today. We're delighted to have Saad Sheikh from Enko Capital. Saad is the co-head of Enko Capital's private debt strategy. Morning, Saad. Thank you for coming.
Hi there, Alan. Pleasure to be here. Thanks for having me.
That's great. So as a start, can you just give us a quick overview of Enko Capital and your private debt strategy and your fund, etc.?
Sure, Alan. Enko Capital is a Pan-African asset manager. We've been going since 2008, founded by two Cameroonian brothers who came together kind of pre-financial crisis and then continued post the crisis to build a very robust multi-asset strategy African asset manager. We've got offices in 5 countries on the 4 being on the continent, actually 5 being on the continent and 1 in London. So we have about 2/3 of our team based on the African continent, including in Ivory Coast, Cameroon, Rwanda, South Africa, and Mauritius. But we also manage local strategies, but we predominantly are a Pan-African US denominated asset manager. Public debt is our flagship and largest asset class, about $1 billion under management there. The second, but the longest standing, is a private equity kind of vertical. 2014 vintage, exited its positions in 2024. So a 10-year holding period, kind of similar to what you were referring to as a holding period of about 6 to 7 years. And top quartile returns with over 10% net return to investors. And the third dollar-denominated strategy is the private credit strategy, which is what with my colleagues, run. And the synthesis of that is there is an opportunity in the market for private credit. And the group saw that based on its large experience in Africa, but more widely with banks on the African continent, and realized that this opportune time to explore private credit and deploy that in the market was now post-COVID. And we've been building since 2022, 23, with our first close in 25, and now just on a very rapid stream of closing transactions. The first close of the private credit strategy was $100 million, seeded by anchor investors like BII, IFC, PIC, the Dutch Good Growth Fund, and a few pension funds on the continent, family offices, and the usual institutions that follow through. We look to reach final close this year, but on a very active drive to invest the capital that we have. So exciting times for the group.
Yes. If you're looking at the different types of credit structures around, what's your fund's focus going to be, and what do you see? Where are you going to see the best risk-adjusted returns?
Yeah, absolutely, Alan. So one of the things that is kind of of predominant importance to us is we've seen what works in Africa, and they're kind of ends of the spectrum. One of them you're discussing later on, which is infrastructure, the kind of shorter tenor spectrum being trade finance. Our view is the real opportunity in the market is mid-market SMEs, as you've already pointed out, that are capital starved. Now, these might be businesses that have access to banking and financial institutions. So we're not saying that they're out of the banking system, but they're just not the preferred choice. They fall out of favor because they're bigger fish to fry for the banks and institutions, including government paper, including multilaterals and corporates. So they just fall out of favor, just given the size, given the opportunity set, given the risk. So we feel on a risk-adjusted basis, that is the place to be. And we're very keen to kind of operate in the space of $10 to $15 million deal sizes, businesses operating north of $10 million in terms of revenue, maybe 15 million and north of that, positive EBITDA, i.e. they're cash flow generating, sustainable track record, audited financials, and the usual kind of management team doing well collectively and growing in scale. And those types of businesses sometimes are not an ideal fit for institutions due to either lack of collateral, lack of appetite in expansion regionally, or just not the right exporting model, long-term contracts, etc. But we feel as long as the cash flow model works, as long as there's sustainable cash generation cycle with a moat that the business has been able to establish over years that we ratify during our DD, our analysis, then that's a business that we want to back. So it's the mid-market space, we think, most underserved, but kind of best in terms of yielding results and returns. They're also the most ambitious part of the investment cycle, where they really want to grow. So the willingness to pay from the investor side or investee side is high. And I think that is the most determinant factor of success in this asset class, that while you have liquidity coming through, is there willingness to pay? Is there enough on the borrower side in terms of being on the hook for them to make it work? And that's also a softer determinant that we look out for when we invest. The risk adjustment does come from liquidity opportunity, the downside protection, which we use multiple layers for, sector diversification, geographic diversification, in willingness of the companies, and that kind of desire and passion to grow. Those are kind of the factors that we look for and how we develop and build pipeline for ourselves.
By talking about that, in terms of deal sourcing, I mean, how robust is your pipeline? How easy is it to find deals that are, meet your criteria? And how, you mentioned audited financials just a moment ago, but in terms of some markets where information is quite thin, how do you deal with that? Do you just not invest there at all, or do you have another approach?
That's a great question, Alan. And this kind of this is where our DNA comes handy, right? So our DNA being African with boots on the ground, physical presence, we've got this kind of finger on the pulse that some do, but most don't. And that's our edge. So that really helps us get an understanding, but also relationships with the market, both institutional, non-institutional, formal and informal. And that's the network that we really kind of rely on to distill information. So we do obviously use the formal channels of audited financials, information available from the company, and distill all of that, run our own due diligence, physical boots on the ground, sometimes even hire external resources to vet the business. But there is another angle to it that we find ourselves quite prudently deploying, which is this kind of finger on the pulse, boots on the ground model, where we get a real sense of what actually works. And the reason I will kind of distill this a little bit more, Alan, is not only are we having people on the ground, we're actually running local currency strategies on the ground. And what that actually means is when you have registered asset managers, there is an information stream that you have access to that otherwise, not being an asset manager, you wouldn't have access to, simply just by the function of how you operate. So it's the regulatory bodies that you interact with. It's the banks and institutions that otherwise would not be interested in talking to us simply on the private credit side, would now want to deal with us because we are such a large asset manager on the fixed income side, on the equity side, on the listed equity side, that they will, and in some way, shape, or form, do interact with us. So that broad network and infrastructure that we have is really our secret sauce in terms of origination, but then in data light geographies and environments, how we really source out and eke out information. One particular example, Alan, if I may, we've recently invested in Angola, a geography that is sometimes not well kind of given credit to. And one of the reasons we were so positive about the environment is our macro hedge fund strategy. It has a strong view on it and has done the macro analysis, the depth of understanding on their reserves, their kind of outlay to geopolitical risks, the entire forward sale of their oil, and how they've been using all of the revenues to repay its debt obligations, yet building internally, but also developing the governance, etc., internally. So that was a geography that otherwise would be kind of frowned upon, but we went in, given our local access, our understanding, and we've just kind of closed a deal on in that geography. So we're not shy investors. We will take on risk-adjusted kind of opportunities in a way that perhaps may seem overtly kind of risky, but we have several layers of risk mitigation. And again, if I may just kind of spend maybe 10, 15 seconds on that, the risk mitigation has to be multifold, right? So, and that's what we did in this deal. We have, outside of Angola, risk mitigants. We've taken AAA or AA rated downside protection on that deal. And that really kind of gives us the confidence that, hey, if this is going to be our first deal in the country, at least we are going in with our eyes wide open. So that's really our strategy. So no market is off the table, other than conflict countries, of course, or anything that is on the sanctions list. But we really are fond of taking risks that is well mitigated and thought through appropriately.
Okay. I mean, let's talk about a little bit more about currency risk. So obviously, I'm assuming your returns are all in hard currency, and your investees are generally generating their revenues in local currencies. How do you manage that mismatch and hedge for any potential outcomes?
Yeah, that's a vital question, right? So one of the reasons why African investing has been quite challenging, I don't think it's particular to, or in my view, it's not particular to Africa. It's particular to emerging markets, that due to the negative capital account that these countries run, the currencies are inevitably going to depreciate, which means you've got to factor that in. For the most part, we do look at businesses that have some natural hedge to that. Either the business itself generates part dollar revenues, or the products that they sell have a natural hedge in fixed or hard in kind of FX aspects. But where we can't find any of those, then we kind of leverage our relationships locally to find swaps or even kind of hedges, as you said. We've previously used MFX, a subsidiary of TCX. But then the question becomes, on a pricing perspective, how much is that going to eat into your kind of return? So again, on the risk adjusted kind of spectrum, how comfortable are you to take that risk? So again, historically, taken hedges, swaps to de-risk that. But natural hedges are also a key component. So we kind of use this whole spectrum of hedging, so to speak, whether natural, inherent in the business, whether our money goes into developing export angles for the business itself, which it didn't have prior to our money. But then with our capital, we will encourage them to look at regional markets for their products. So that is all part of the assessment, but we will in all cases de-risk that and hedge it in one way, shape, or form. We do look at double-digit returns. So the aspect of currency hedging cannot take us into single digits. So again, that is a factor. But I haven't seen a deal where we have walked away because of the currency risk that we were unable to mitigate. But obviously, these things can happen in the future. So we just very mindful of currency hedging has to be placed. We can't be naked risk takers on the currency. There is an inherent devaluation that will happen. So we have to be clever about it and just, again, be very vigilant how to manage that. Sometimes it's about understanding where the country is in its devaluation cycle, because the devaluation cycles normally run in step changes. So if there's a recent devaluation for the immediate term, you might not require a hedging product, but you may need one 2 years down the line. So again, thinking a little bit outside the box in those terms helps us structure efficiently.
Well, moving on to exits, obviously, private credit deals are theoretically self-liquidating, but oftentimes extensions and amendments and maybe general restructurings happen. How do you manage that, and how does it impact your ability, or how do you think it's going to impact your ability to recycle capital into new opportunities?
Yeah, I think that's the inherent question of the credit private credit asset class. I think it's very clear that this asset class is one where you cannot model it on, we'll take some hits and punches as long as some of the other deals perform will be good. That's not the business model. Every single deal within your fund has to perform for you to generate decent returns for your investors and hit your target return. So it's very clear that you can't have write-offs, complete write-offs. So mitigating that is very important. However, there are kind of black swan events. There are factors that you can't foresee when you're going into an investment, and 5 years down the line or 4 years, whatever it may look like, things change quite rapidly. And unfortunately, as a geopolitical landscape, Africa is susceptible to whatever happens globally. So we do factor that into the model. So first and foremost is understanding where the business is in terms of its development and growth. And sometimes businesses will kind of make sure that their obligations to an investor like us are met under all circumstances to make sure that they remain resilient moving forward. So businesses tend to think very hard before requesting for a restructuring or requesting for extension of terms. Because the way that the model works is there are two disadvantages to any restructuring. First of all, any restructuring means that the obligation of the business just continues to prolong, and that's high high cost of capital that they've taken on. The longer it goes, because it's IRR dependent, the cost of capital increases. So it's really not in the business's best interest to prolong that. It might be most suitable or more suitable for the business to refinance out hard currency investments once they've grown to a certain level. So again, being as part of that journey in the business, being the supporting element of the business, but also considering being a thorn in the side, so to speak, for lack of better words, or being crude in this sense, but just being kind of brutally honest. That if you've demonstrated that value to the business, that your capital as in terms of Enko's investment has really helped the business go miles in terms of their growth and accelerated that growth, but now might be the time to refinance us out, is not a hard conversation. Because the business might have reached an inflection point where local currency capital might be more beneficial. So again, we do a lot of work in local currency as well. So that's an easy conversation for us to have. The second one is, if you're going to restructure, do you understand the real cost of capital, right? And that's an honest discussion that we have with the business for them to really understand what they're getting into. And if that is something that is essential for the business, for the survival of the business, then sure, we will get involved in that discussion. But in most cases, we've seen alternatives exist. And it's just highlighting those alternatives, which is beneficial for us because we still meet our timelines of recovery of capital and, as you say, then reinvest that capital. Having roadblocks in that, I'm not going to discount that. It does happen. So it reduces your ability to reinvest, which is a detriment and something that has to be really thought hard. But then again, the whole concept of private credit is you do have a stick. And that's where it's slightly different to private equity and other asset classes, where you do have the opportunity, if you've structured correctly, to go and liquidate some of the kind of downside mitigants that you have and recover capital from there. So the principle thesis of private credit is that if you set a target for yourselves, that you get as close to achieving that target in terms of recovery as you possibly can. Sometimes things won't go your way, and that's kind of you paying your school fees. But the idea is staying as close and true to that model as possible.
Okay. Okay. Final question. It's all been great. Very interesting. Blended finance. Do you or will you participate in any blended finance deals, and how efficient do you think the structure is at getting mobilizing more private capital into harder markets?
Yeah, thanks. I think it's a fundamental topic for Africa. I think, in my view, and I just give you my view, and as brutally honest as I can give you, in my mind, blended finance works on the extreme ends of the investment landscape. Very early stage investing and very late stage, huge, large infrastructure projects. I think beyond that, if you continue with the blended finance model, it then kind of puts the question in people's minds, is this actually a sustainable investment landscape and environment, or whether it is a sustainable investment landscape or not? Because blended finance is really there to de-risk something that is extremely high risk. Our model, or modus operandi, is that we believe that there is appropriate risk in Africa to take without having to blend it in a format or de-risk it in a way that you require layers of capital in your investment kind of pool of capital. So again, very, very cognizant that blended finance will work quite efficiently in the very early stage and very late stage, because again, you do have dearth of capital in large infrastructure projects. There is local capital streaming in, but not as much as needs to. So sometimes there are layers that you need to create to give external investors or large investors the confidence to come into the market. But the mid-market range that we operate in should operate on its true risk profile. That risk is able to mitigate itself, or through the cycles of the business, through the cycles of the geopolitical landscape, you should be able to come out the other side without blending. So again, I have a mixed view. I think the space that we operate in has the opportunity to prove itself, and this is demonstrated by international markets as well. You don't see blending happening in the mid-market space in the US and Europe, but you do see that on the periphery. So that's how we look at it.
Right. Great. Well, thanks very much. Unfortunately, we've run out of time. I mean, there's obviously a lot more to talk about. But thanks very much for taking part today. That's great. And
Thanks, Alan.
good luck with the fund close and make sure we know about it when it happens.
Absolutely. Will do. Thank you very much.
Have a good one. Thanks.
Thank
Bye.
you. Bye-bye.
Hello, Biju. Good morning, Biju. How are you? Or good afternoon, I should say, where you are. Can you hear me okay? We're having a slight technical trouble. Sorry about that. Let's just see if um, what's happening here. Yeah. Okay, apologies everyone for this slight snafu. We'll have to work out what's happening. I'm just going to see what's happening. Hi, Biju. I'm just asking you to unmute if you can hear this. Hmm. Hi, Biju. Can you hear
Hello.
me?
I can
Hi.
hear you.
Can
Can
you
you
hear
hear
me?
me?
Oh, great. Great. I can hear you
Oh,
now.
brilliant.
Unfortunately,
Okay.
brilliant. Sorry about that slight snafu. Thanks very much for joining us today. Um, Everyone, this is Biju Mohandas, who is the global head of healthcare and life science investing for LeapFrog Investments, which I think, as everybody knows, is one of the most important impacting investment firms around. And he's going to talk to us today about private equity investment in the healthcare sector, which, as we mentioned from the ASCA numbers at the beginning, at the top of this webcast, is one of the most active and the most uh, interesting sectors around. So for the next 10 to 15 minutes, we're talking to him about that. So Vijay, thanks very much again for joining us. Obviously, healthcare investing covers a wide range of types of businesses, whether they're hospital groups to pharmaceutical manufacturing companies or diagnostics and digital health companies. Where does LeapFrog play, or where does LeapFrog like to play in this landscape, and why?
Sure, Alan. So to take a step back, we are impact investors, as you pointed out, investing from our fourth fund, have about $3 odd billion under management across four funds and a few vehicles. And our investments are exclusively focused in financial services, healthcare, and climate. And we invest
Mhm.
exclusively in Asia and Africa. So in these markets, in Asia and Africa, um, before asking ourselves the question which of these subsectors one wants to invest in, we would ask the question, what is the demand supply mismatch that we are trying to solve? What's the nature of the healthcare system? Obviously, very different markets, very different countries, but certain themes are cross-cutting across all of these countries in many respects. One of which is that all of these markets are seeing people live longer, which is great. All of these markets are seeing, however, people spend larger chunk of their life in poor health. So there is decent enough healthcare, it seems, to be to increase the lifespan, but not decent enough healthcare to prevent illnesses, particularly chronic ailments. in these markets. So if you take that as a very high level, the cross-cutting theme, for us, what that means is any investment in entities that are able to prevent illness, enable wellness, which in turn means shifting individuals' behaviors, taking healthcare from something that happens in hospitals and clinics to something that happens closer home or at offices, something that is episodic, which occurs once in a while, to something that is regular, where a person's health habits are changed, what he or she eats, whether they conduct workouts, exercise, etc. And finally, shifting the agency from clinical workers, doctors, and nurses and other paramedical staff to the individual himself or herself. So all of this means healthcare ought to get closer to the customer. And in order to achieve that, the simplest, most efficient way that we have found over our years investing in this space is an omni-channel approach, where you set up large numbers of asset-light healthcare units, combine it with technology to access your customers, to get healthcare closer to them. And these kind of businesses we find very attractive. And within that, there's a great example, retail pharmacies, which we have successfully helped build, one of the largest in the region in Good Life, which we subsequently exited last year. We are very keen to look at opportunities in diagnostics, which are also very asset light, and play to the same themes. We have done a lot of diagnostics in India, for instance. We are the investors in the largest molecular diagnostic platform in India. We are an investor in one of the fastest growing large omni-channel diagnostic platform there. We have recently closed an investment, not yet announced, in Vietnam with similar themes. So we really like asset light healthcare. We also are interested in and have experience in hospital investments. We would like to do it, however, very selectively. One of the other cross-cutting themes across all of these markets is urbanization. So in certain countries, there is significant urbanization outside the 1-2 top cities. India, for example, Vietnam, Indonesia, certain African markets as well, but not to the degree that one would see in some of these other markets. So if urbanization is happening at a scale where we feel there could be opportunities to invest in hospitals in tier 2, tier 3 towns and cities, we would be very keen to look at that. We have done one out of our fourth fund in Philippines. So broadly, those are the spaces that we really like. We have not ruled out any other spaces. We have experience investing in pharma and medical equipment distribution. We have experience investing in manufacturing, but these two, you could say, are our sweet spots for the reasons that I mentioned.
Okay. So when you look at creating value once you've made your investment and you're starting to obviously build the business or help it expand, I mean, that's quite difficult to do in the healthcare sector. There's always this sort of tension between the commercial pressures as well as healthcare delivery quality pressures. How do you manage that? And what have you found works for you and the businesses you back?
I think the answer is in your question. We feel very strongly at LeapFrog that a big central component of our value creation ought to be improving, enhancing the quality, the medical quality, the clinical quality of the business that we are in. We feel we are well suited to do this, or at least support the management teams in doing it. We are, as I mentioned earlier, sector-focused investors. A lot of us have only done that, investing in the healthcare space. Some of us have a clinical background as well before venturing into investing. So we think of that as our sweet sauce, and also something that allows us to provide some distinctiveness to the company, and ultimately for the company to stand out in among the crowd. So, for example, again going back to Good Life, it's a great example where we went in when the company had about 20 odd stores, and there were multiple pieces through which we added value, bringing in high quality management, improving their customer focus, etc. But the single biggest differentiation was our work with the management team to enhance the quality. We did an audit of the supply chain and made sure that there were no leakages, such that we were able to provide a covenant as Good Life to any patient walking in, that whatever medicine that they would purchase from Good Life would be of the highest quality. And that, to your point, also meant having to compete with mom and pop shops, some of whom, not all, some of whom indulged in practices which were inconsistent at best when it came to quality. But ultimately, a customer who is spending money on his or her health is smart enough to differentiate between poor quality and good quality, particularly when they have the choice. When they do not have the choice, it's a very different matter. But if you create a choice and if you are active in communicating that to the consumers, which again, we focus a lot of time and effort on, I actually believe that it is a positive. It's not contrary to commercial imperatives. If you have a high quality business, the commercial returns will also be very, very high clinical quality, I mean.
Right, moving on to, I mean, obviously healthcare is a politically sensitive sector, let's put it that way. How do you underwrite or account for regulatory risk when you're evaluating an investment? And has any sort of major regulation or regulatory body made you alter your investment thesis on a portfolio business you already had backed?
So firstly, we are emerging market investors, geopolitical risks, regulatory risks, these across multiple sectors, financial services, where we operate in, the climate sector as well. There are regulations do have implications to how one makes investment decisions. In the case of healthcare, particularly because we only invest in entities that are either already performing well above the regulatory requirements from a quality perspective, in a manner where the ownership and other requirements that regulators sometimes require of investors in the space, we make sure that things are kosher going in. If things change, and I can't think of situations where direct regulatory interventions have resulted in us having to change course once we have gone into an investment. There are situations where, for example, government health insurance schemes are a big portion of some companies' revenues, and you realize that that scheme itself might be unsustainable in the long term. So one tends to figure out other revenue streams, et cetera, et cetera. So those kind of things happen. But in terms of regulations catching us off guard, either before or after investments, I don't see a lot of that happening. And overall, in most of these markets, you're right, it is politically sensitive, but I would go so far as to say in a lot of the emerging markets in Asia and Africa, at least so far, it is less sensitive than what you would see in some of the developed markets, because unfortunately here, the government, the people, investors, entrepreneurs, everyone realizes that public healthcare is ideal. It'll be great, but it's just not there yet. And the fiscal space for governments to build massive public healthcare is non-existent. So private healthcare, it's almost a given that private healthcare is seen by regulators as important part of the government's mandate in providing healthcare to their citizens. So I should say I've not found regulations to be a major issue. Obviously, one has to be cognizant of it, respectful of it, which we are.
Okay. All right. As a final question, tell us about the exit market for healthcare assets in Africa. What you're seeing, what are the challenges, opportunities?
I was laughing because it's I think if anything, healthcare has a reasonable exit markets, but overall exits in Africa are not as easy. And this is for people like you have been following the markets over the last several years would know. It's structural. We do not have yet vibrant stock markets across multiple countries that one would like to see. There is some hope that, say, Lagos, for example, is now potentially coming back to life. Northern Africa, Morocco in particular, has been interesting and exciting, but with few exceptions like those. The stock market as a route, local stock markets as a route to exit is narrower than, say, in Asia, where if you're investing in India, the stock market is booming. A lot of local retail investors are investing in the stock markets, and IPO numbers as well as volume in terms of the amount of money raised by IPOs has just been record breaking over the last several years. So that's one avenue which is blocked. The second avenue, large buyout funds coming in and acquiring investments from smaller investors, that's pretty much non-existent now that Carlyle and KKRs, etc., have seeded the market, and TPG is super selective. So it is essentially, if you're a good investor, has done all the hard work, the company has grown, then your option in terms of sale or exit is essentially a strategic. And when you have narrower options, the difficulty level obviously goes up. So it is difficult. Having said that, it is obviously possible. And therein comes some of the pieces we discussed earlier: quality in terms of clinical quality, governance, ensuring high top-notch management teams are present, a brand equity which is valued by whoever is buying it. Everything that is strategic would really consider super important is necessary to be built. And if you do that, then one does get that exit. But overall, without any doubt, it's a pretty difficult market when it comes to exits, in my view.
Okay. All right. Well, on that note, thank you very much. It's been great that you could join us, and we really appreciate your insights. And I hope to have you on another one in the future. Thanks very much.
Thank you, Alan. I wish I could have stopped on a more healthy note, but I think exits across sectors are tough. But thank you for having me, and all the best.
Thank you, and you. All right. Now we're going to move on to our next guest, who is Kobina Sam. Kobe is the Managing Director for Emerging Markets Alternative Credit at 91, which is one of the biggest and most important asset manager and investment firms based in South Africa. Kobe, can you hear me?
Hi, Alan. Thanks for having me.
Hi, thank you very much for joining us. How are you today?
I'm very well, and you?
I'm very well. Good to see you. So, tell me, just to get some context, can you tell us and the audience a little bit more about your private credit fund, and particularly with relation to its investments in corporate infrastructure? I know the project finance is not in your wheelhouse, but on the corporate infrastructure side.
No, absolutely. So 91, as you mentioned, is a South African-born global asset manager that focuses mainly on the listed markets. So as a firm, we manage about $200 billion. About 60% of that is invested in emerging markets, including Africa, and 40% in global markets. But most of the firm is listed. We have a little piece of it, about 5%, that's unlisted, and that's where I sit. And in that, we have two big buckets. We have developed market alternative credit in sort of that alternative bucket of 91, and emerging market alternative credit. So I'm one of the MDs in emerging market alternative credit. And within emerging market alternative credit, we ran three main strategies. I call them three legs of the stool. We have infrastructure credit focused funds. We have corporate credit focused funds, which is where I sit. And then we have energy transition funds. And all of these are EM focused funds. And the history is, as a firm, we started investing in South Africa doing credit investments in 2008. In 2014, we launched our first dollar Pan-African fund, investing in credit across Africa. And in 2022, we went full global EM. And on the corporate side, we run, I call it sort of a big tent strategy. So it's broad private credit. Most of what we do is senior secured, but we do some junior and some mezzanine and some special situations. Most of what we do is private, but when there are market dislocations, we do have the flexibility to invest a small minority of our funds in the listed universe. And a big part of what we do is general infrastructure, broadly defined. So digital infrastructure, social infrastructure, as well as the traditional roads, bridges, ports, etc. But we come at infrastructure more from a corporate finance lens. So it's not project finance tied to sort of long-term PPAs and that sort of thing. It's more infrastructure that's thought of in a corporate finance lens. Shorter tenors, typically higher yields, traditional security as opposed to relying on some 20-year PPA with the government or that sort. So long response, but hopefully that gives you the context. Alan, you're on mute, for me at least. Can you hear me? Because you're on mute. Hello? Hmm. Give me 1 second.
Can you hear me now?
I can hear you now.
Oh, great. Okay. I'm sorry about that. It's weird. I don't know what happened there. Um, so thanks very much for that introduction, and apologies for again, another technical snafu. Um, where are you guys seeing the most compelling opportunities at the moment? How has that shifted in the last 2 or 3 years, or has it?
Look, I think that year on year, we see shifts in where opportunities show up across sectors and across
Right.
geographies. If I step back, in general, we see the highest volume of opportunities in global emerging markets outside Africa.
Hmm.
We see the most opportunities from Latin America, with the most attractive yields, followed by Asia. We see lots of opportunities, but the yields are not that attractive, the risk return. Central and Eastern Europe, we see very little. Middle East, we see some opportunities, but again, the yields have historically been very tight. And then Africa, we know very well, and we're always able to find opportunities, and the risk return is quite attractive when we do deals in Africa. So I'll say Africa probably has the best risk return to offer. It is slightly harder to find opportunities than in the other geographies, which
Right.
will be logical given the relative size of the economies.
Right.
And sector-wise, we're seeing quite a bit in digital infrastructure these days. We're seeing quite a bit in renewable energy.
Hmm.
Financial services has historically been a big focus of ours, but this year and most of last year, we haven't seen much. Telcos is a space we see quite a bit in. We see quite a bit in consumer type businesses that have been backed by the private equity sponsors across the continent. Because we have a dedicated infrastructure strategy, we see a lot of infra, and we're able to cherry pick which ones make sense for the corporate book. So hopefully that gives you a flavor.
Yeah, no, I mean that squares well with what we're seeing as well. If you're looking at the value creation of the companies who you're learning in, what is sort of the biggest impediments they face? And if you look at the stronger performing ones, what's driving the returns there, do you think?
Look, I would say, as a credit investor, we look at things a little differently, right? Outside of mezzanine investments, our returns are fixed and we don't really participate in the upside. So the lens we apply is really to say, why are we comfortable we're going to get our money back with a prescribed interest or coupon? And what we find is, not surprisingly, bigger companies are more resilient. Good governance is critical, right? So backing the right sponsor is, again, very important because they ensure good governance. They have a plan to deliver the growth that gives you the return. But, most of these points are more, like common sense type things. I would say avoiding big FX mismatches, right, is important. Even though as credit, we're higher up the capital structure, so it takes a while for us to get wiped out. But avoiding big FX mismatches is important. And avoiding really cyclical businesses, that's also important because, one season they're up, the sun is shining, and then everything turns and you're in long, dark winter.
Right, right. You mentioned renewable energy. I know you have sort of oversight over the energy investments or a view on the energy investment. How's the transition agenda providing opportunities for 91 and the capital flows that come with it? How's it reshaping your opportunity set, would you say?
Look, I think we look at it from a fundamental point of view, right? The sentiment ebbs and flows depending on what's happening globally, depending on what's happening with politics in other jurisdictions. So we look through to the fundamentals to say, look, there's an obvious energy demand, right? And then there's the supply side, and there's a question of what's the mix of that supply, or what can you do to reduce energy? And as recent disruptions have shown, it's really important to have a diversified supply mix and and sources of cost that are not globally sort of centralized, right? That can be localized as sometimes important. So that's the preamble. But what we see in general is good renewable investments or good renewable opportunities always justify an investment, right? If the project makes sense, if the service being offered makes sense, you can underwrite that credit and make good money, be it, solar, be it wind, be it, electric buses. So, we've done things from sort of embedded power generation, right? Where you see businesses that go to big industrial and commercial users and say the grid in some of these countries is not reliable, will provide you on-site power. We've done things like fund electric buses in certain jurisdictions, right, in Africa and outside Africa, where you have a municipality that says, I just want to green my fleet. I'd only be subject to the ups and downs of diesel or gasoline or petrol pricing. And so I'm going to introduce a fleet of X100 buses that are electric. Right, so these things run the gamut. We've backed, renewable energy platforms in Africa, in Asia, and then the other angle this is coming at is over the last 2-3 years, you've had a massive buildup, or you've had a massive explosion in AI. We're all sort of exposed to it and dealing with it, and behind that, you have data centers that have to power these things that are being built with enormous amounts of leverage. And the data centers all need to be powered. So you have a long-term secular trend of increasing demand for power and increasing demand for data centers to support this AI that's developing rapidly. And we're always looking for opportunities to fund all these pieces of the value chain that make sense. Now, what you always have to be careful of is a significant amount of capital that needs to be spent. And you want to be in the part of the spend that, makes sense and returns your capital back plus the promised return.
Right.
Because some of that capital may be spent in ways that are not prudent.
Okay. Great. Well, as a final question, and I know you've talked about a number of different sectors, is there any one of them or is there any other that you think on the infrastructure side, the corporate infrastructure side, is underappreciated, let's put it that way, by global investors in Africa? Which are the ones,
Look, I
which is the
think
sector that should be
infrastructure.
paying more attention to?
No, I think the whole sector as an asset class is underappreciated. And so I think it was Q1 last year where the multilateral development banks released their default rates in infrastructure across regions. And you can see that Africa has the second lowest default rate in terms of infrastructure investments based on the books of the World Bank and other multilateral development banks. I don't remember the other names. But when we speak to global investors, the perception is Africa is risky, and they keep asking for a higher return. And they say, well, if I'm going to think about Africa, I need to justify it, and so I need a much higher return. Why? Because it's risky. Why is it risky? It's my perception, and a perception is a powerful thing to dislodge. But we point them to the data and we say, look at the loss rates. Infrastructure projects in Africa have lower loss rates than every other region in the world, bar, and I stand under correction, Asia, right? Second lowest loss rate among the regions. And so you can make good money. There is a significant deficit of infrastructure in the continent, on the continent, that you can find. So your development impact is massive. And lastly, because a lot of this is being built, you're not refurbishing existing infrastructure. You can do this in a greener, more efficient, more logical manner than having to redo 50, 70-year-old infrastructure.
Right. Interesting. Okay, well, that's a great point to end up on. Certainly your point about risk perceptions will take in our next webinar, which is at the beginning of May, is going to be focused on Africa's risk profile and trying to say, what is it really like? But we'll wait for that discussion. Thanks very much for taking part today. We really appreciate it. And I apologize for the loss of sound somewhere in the middle of it, but now we can all hear each other and all speak to each other, which is great. So enjoy the rest of the week and many thanks once again.
Thanks, Alan, and thanks everyone who joined. Have a good day.
Thank you. Thank you. Okay, as the final part of today, we're going to be talking to Nani Detti from KRL International, our partners on this webinar series. KRL, as I mentioned in the opening, are a strategic advisory consultancy in Washington, based headquarters in Washington, D.C., but spend an awful lot of time in Africa. And in fact, she's in Addis as we speak. There's a lot going on in Washington, isn't there, Nani? We're talking about the US government's approach to investment all over the world, but also particularly in Africa is changing. So Can you give us a sort of like thumbnail sketch about the key things that have happened? Just it's moving on a monthly basis, and highlight some of the where the opportunities might fall.
Yep, absolutely, Alan. And thanks for having me today. Hopefully you can hear me loud and clear. For everyone
Can, yes.
joining. Okay, perfect. Well, Carol, let me just start by introducing our firm. Carol is a strategic advisory firm based in Washington, D.C., and our specialty is Africa. We support U.S. companies and various investors interested in the continent, enter different markets and operate across different sectors. Currently, our focus is mining, energy, banking, but again, opportunities on the continent are endless. So we find ourselves switching gears every now and then. I'm going to briefly cover the view from Washington in terms of where U.S. Africa policy stands. And my remarks will be around kind of the recent conversation that we've been seeing from the Trump administration around commercial diplomacy and the move away from aid to trade when it comes to the continent. So first up, let's think of the sectors that the current administration is focused on, and that is critical minerals, energy, and infrastructure. I'm sure you've all seen various reports on critical minerals deals that have been signed with various African countries. And the US is pretty focused on securing the critical mineral supply chain and countering China. And so that will be the core of a lot of the deals that we're going to see. And energy and infrastructure, simply because, as we know, the continent has a lot of needs, and we are going to see more US companies entering those sectors. Now, I want to outline maybe the priorities under this administration when it comes to Africa. So first up is commercial diplomacy. We've heard a lot of conversation around that. And essentially, right now, a lot of US, and not a lot, but pretty much all US embassies and US ambassadors are being evaluated on how many deals they secure and how they're supporting US companies. And so diplomacy is pretty much tied to business, and that is anchoring US Africa policy right now. And we're going to see a lot more trade trips and business trips that US companies will be taking to the continent to seek out opportunities. So commercial diplomacy is really the core mission when it comes to US Africa policy right now. Second, coming to infrastructure, we're going to see a lot more focus on identifying bankable projects, but very specific ones. So the era of just, broadly dumping money into different countries where projects aren't tracked is over. And this administration has made it clear that if they are going to be backing any infrastructure project, it has to have US content. It has to involve US companies. And one interesting and maybe positive development that we're seeing is with the Lobito Corridor project, where the US is involved, but so are other countries. So I think the US is going to play a lot of role in terms of using its convening power to bring in other players. So infrastructure will continue being a focus, and the DFC, which is now reauthorized and has a new CEO and is the investment arm of the US government, is going to be focusing on deals with US content and US companies. And third is China. So countering China is going to be probably the top priority when looking at any deal in any sector for this administration. There's going to be a lot of push to level the playing field for US companies, encouraging more transparency and pushing for more regulatory reform in the different markets that companies are seeking to play in. And another point that I want to flag is that there's a lot of conversation when it comes to US investors, being scared or risk averse when it comes to Africa. And I think part of the conversation is going to have to be informing them of the opportunities that are available and encouraging them to come to these markets, and kind of dispelling the myth of just some of the risks that are perceived to be there, but may not be there. So countering China will be a top line priority for this administration. And then another area that we're seeing more of is when it comes to the interagency, be it DFC, USCDA, EXIM, and others, there's a lot more coordination with the interagency now than before. So DFC is no longer just looking at the pipeline of projects in front of it, it's constantly talking to other agencies and trying to see how do we pull in the different tools and resources that we have. And I think that's a positive development. And hopefully we're going to see a faster timeline when it comes to financing some of the projects on the continent. And then I want to close by something unique that we're seeing now that we haven't seen before, which is that the U.S. government is now taking a direct stake in some projects, and in other projects is pushing specific U.S. companies to get priorities and have a stake. So, for instance, if you look at some of the critical mineral deals that have been signed, most recently there was a deal in the DRC where a U.S.-based firm, Virtus Minerals, essentially acquired a mine and is now, part owner. And I think we're going to see a lot more of that. And it's definitely a shift from the way we've been doing things before. So overall, I'd say trade, investment, securing critical mineral supply chain, and overall, making sure that U.S. companies dominate sectors is kind of the priority for this administration. And that should sum up where things are right now.
Thanks for that. And I think I'd just add to say that our observation is the train has just started rolling out the station. So certainly if you're in America, you should be leaping on it. The DFC was reauthorized. The DFC was reauthorized at the end of last year with its balance sheet being quadrupled, I think, up to 205 billion.
Yep.
And it's the different types of assets it can invest in has been broadened too.
Yes.
So that's great. Thank you very much for that overview, Nani. And also, as I mentioned earlier, when Kobe finishes his remarks, risk is very much the focus of our third of 5 webinars, which is taking place in early May. We're going to be looking at Africa's risk profile, the perception, what is the real risk profile, and talking to various professionals of within the industry who are really focused on that. So I hope that you'll all be able to join us. We'll certainly be making sure that everybody who listened in to today and also to our first episode will be advised as to when it is, so you can tune in if it's of interest. And also to mention that we have the recordings of these, which will be sent to everybody and hosted on our YouTube channel at Africa Capital Digest for everybody to download thereafter. Thank you once again to all the speakers today, and thank you very much to everybody for taking part, and enjoy the rest of the week.